Hi, I'm Greg Hunter. Welcome to USAWatchdog.com. With us another new guest, and this guy, I've been reading his work on the internet for 3 or 4 years. It's really detailed. It really exposes a lot. It's not speculative. It's always backed up with charts and statistics and information. And I'm talking about Gordon T. Long of GordonTLong.com. Gordon, thank you for joining us today on USA Watchdog.
Oh, thank you for having me. I'm looking forward to talking with you.
Well, a little bit about you.
Your work also, so.
Thank you. Well, you're on, and I've been wanting to get you on for a while, and you have some deep experience, 20 years as a senior management at places like Motorola, IBM. You are an expert in investment finance. You've brought up startups to the market. You do analytics and research, and you analyze the markets. You're an expert in all these different stock market, gold, all this stuff, and you really put out some great stuff. Your most recent work, and I just printed it out here, and it's Mysterious Bond Buying. That's out that you did with another smart guy, John Rubino at Dollar Collapse, another guy I'm going to try to get on. But anyway, listen, we've been talking about this bond buying, and one of my sources, who's a friend of mine, Greg Manarino, says, listen, there is no real tapering. They say they are, but they're not. They're still buying bonds in some fashion, way, shape, or form. I've had Rob Kirby on of Kirby Analytics. He says, listen, they've bought all these bonds in Belgium, and you have taken this mysterious bond buying to the next level. What's going on with the Fed and the bond buying and the Treasury? I mean, they're not really tapering. Somebody's buying our debt, correct?
It's all kind of a sleight of hand. That's what's going on here. And it's subtle. When you really look at it, there's really 5 possibilities of who is doing this mysterious buying in Belgium through the Euroclear. It's either the Federal Reserve, the U.S. Treasury, the ECB, the People's Bank of China, or possibly the Bank of International Settlements or International Monetary Fund of the Bank of International Settlements. They all have different motives for doing it. They all have reasons for keeping it quiet, and they all have access to the capital to do it. So without boring your listeners with the various reasons, my conclusions from it, it's really the U.S. Treasury. Working very closely with the Federal Reserve, and it's a very good observation that your guest had made, because when this buying began last October and November, it was quite dramatic and very fast, and it sustained itself. But we were just introducing taper at that point. Taper starting in January at $10 billion a month, but now now that we're sitting here in June, it's pretty clear that it all netted out. It was a little bit of front running. From October to April, that Belgian buying is total about $186 billion. As of this morning, the taper reductions are approximately $160, $180 billion. So a little front running and all nets it out. And they would have to do this in advance to send clear signals to the market.
So the Fed, if I may interrupt, so the Fed
than just that.
So the Fed may be tapering, in effect. They may be really tapering, but they're just taking the bond buying and putting it over somebody else is buying the bonds.
You got precisely. Well, remember, the Federal Reserve owns the U.S. dollar. It's a U.S. dollar note, or Federal Reserve note. It's their product. The Treasury is not their product. That's the U.S. Treasury's product. So whose best interest is it that it's sold? And that is the issue here. Because if it hadn't been for the Belgian buying, we would have been seriously short of buyers. Granted, the deficit is down to, $700 billion from well over $1 trillion, but there's still a lot of money that's got to be financed. Russia's been selling. China's down, hasn't been buying, down marginally, and Japan. So who's going to pick up that tab? That's the problem. And I don't think that most people are fully aware that the foreign direct investment into the United States has been steadily falling since 2008, both private and public, and it's just about to go into contraction. So there's a sincere lack of buyers of U.S. assets overall, in spite for the equity markets going through the roof.
Well, they could. Well, we'll get to that in a minute about how your report says they're buying. They're basically financing it to buy their own stocks back. But just to finish this one thought, well, they could sell the debt. They couldn't sell it at 2.3, 4, 5, whatever, 6%, whatever the 10 years, 2.5%, 2.6%. They couldn't sell it at that for 10 years. They could sell it at maybe 4 or 5 or 6 or who knows what. They could sell it then. But that's the problem, isn't it?
Well, that is exactly that's the last thing they need. We have 75 million baby boomers about to retire. They're going to start drawing on Social Security and Medicare, and there's no money in that box. We have 10,000 a day, so there's a need for a significant amount of money that's no longer actually being able to flow on a monthly basis. So what are you going to pay for that money? Are you going to pay 4%? Well, right now we're having a tough enough time doing it 2.5%. The whole idea of financial repression, which, by the way, is what we're in, and I don't mean that's not a negative connotation. That's a macroprudential macroeconomic approach of using negative real interest rates in a manner that will allow you effectively to repay your debt off. It kills pensioners. It kills savers. The bottom line here is that the Federal Reserve, working with the Treasury, they need to get that 10-year much lower than 2.5%. And all the speculation right now is that the bond is going higher in terms of yield and down in price. I don't believe that. I happen to believe we're well on our way to 1.5 or lower on that 10-year yield, which will push up bond prices. And what's critically important is to put up collateral values. We have a serious shortage of collateral, which will allow credit to turn into debt. And as you know, money does not come into existence in the U.S. Federal Reserve System unless debt is created. So they've got to push it down. And that's part of why they've not only got to sustain the buying, but they actually right now need a shock to the system, what I'll call a bond scare, so that money will move from an overinflated equity market. And I think you would agree that the markets are at levels we've just never imagined were possible, and disconnected from realities on most measures. So if they move, if there's a shock and it moves, we pushed up the equity prices so that yields now look terrible on the because the dividends against higher equity prices. So suddenly bond prices look relatively attractive. And you're a pension plan, you've got to be fully invested. What are you going to do? And they need that to drive down the interest rates, push up the bond price, protect collateral, and get that financing charge much lower. A little long-winded there, but I just want you to understand the real game that's going on here. It's a complex game, but I guess it's not. It's pretty simple what they're trying to do. They're trying to finance the government's debt.
So, Gordon, you mentioned about the stock markets at record highs, and I'm thinking, is the Fed involved in that too? Are they artificially pushing that up? That's what my guests say. They say there are no free markets. I mean, they're buying back a lot. There's a lot of announcements to buy back stocks, a couple of billion, 10 billion, whatever it is. I mean, where are they getting that money? And is that pushing the stock market up to these record highs?
Exactly what's going on. It's on multiple fronts right now. It's not just the Federal Reserve, it's the central banks who are all, I'll call them, managers of the fiat currency. And those are four primary currencies: the euro, the yen, the sterling, and the dollar. And they control 90% of the global trading of currencies, and they're all fiat. So if you debase together, there's not much place to hide other than in hard assets and some other brick country kinds of shelters. But what's happened is these central banks, specifically the People's Bank of China, Denmark, Switzerland, the central banks are buying equities on a foreign basis. We have 400 public institutions that are buying, and these are sovereign wealth funds, these are pension plans that are controlled by governments that are now aggressively buying equities to the tune of $29 trillion in holdings that they've taken out of the market. And remember, when they buy them, these generally don't trade. So they're actually withdrawing them. So the volumes are down in the market. And the breadth is very shallow, but it doesn't take much when you're getting smaller and smaller available stock out there to buy. And if that's not bad enough, what we've now got that's the public side of it. On the private side of it, the S&P 500, the level of which we're now seeing buybacks, that it's just unprecedented. We have 80 to 90% of all profits from all of the S&P 500s are being turned into buybacks and dividends right now. Out of 365 corporations of the 500 have aggressive policies to do that. So if you look at the earnings the earnings are being driven on earnings per share, on just less share. And as easy and as trite and as silly as that little game sounds, it's working. And by the way, it's the same gig in that they're taking those stocks out of the market. That's a lot of stocks to be pulled out of the market, to the tune of about $1 trillion in the last 2 years out of the S&P 500. $1 trillion in 2 years of buybacks. And I just found it staggering, and I went through those numbers so many times to actually verify them. And I could talk about IBM and I could talk about Caterpillar and Oracle and Apple. I mean, some of the high-flying stocks themselves, you'll see a direct correlation with the degree of their buybacks and the increase on their debt, at least on the balance sheet. And we all understand there is a tremendous amount of debt that's off balance sheet, that there's really no way of knowing what it is anymore. You can read the 10Qs and the 10Ks, and I challenge you to find out how much you can really understand whether it's off balance sheet and an SPE or an SPV or any of these acronyms that are created to hide debt. The corporations have to do this, because right now you've got the whole private equity industry with free capital, basically, who are hovering, ready to take out these companies and load them up with debt. So if you're a CEO, not only are you trying to drive up your stock price because of your bonuses, you're trying to protect the company. Because if your stock price is your collateral, that's your currency that you're going to use to do acquisitions. You can't grow any longer organically, realistically. You've got to grow through accretive earnings. And therefore, you need a high stock price. And this is one of the easy ways to do it. If you don't do it, a private equity company is going to take you out, load up your balance sheet, pull out the dividends, and I won't say you're toast, but the real losers in this, pensioners, savers, long-term investors.
But isn't there a price to pay for this mispricing, this manipulation? I mean, you can't have the nirvana of low interest rates, high bond prices, high stock prices, without, and cheap money. Something has to give, and isn't that ultimately going to be the dollar? Aren't people going to at one point go, woo, I need to run into gold or land or any physical asset? Isn't that the problem, that you could capsize? Everybody's on one side of the trade, one side of the boat. Can't the boat turn over?
Well, it will turn over at some point. I don't think we're there yet. I think the central banks still have some more games that can be played. But you're absolutely right. Where this ends is with in fact, a currency collapse. And and maybe the word collapse is the wrong word. It could take that tone and be very, very violent. Because remember that hyperinflation, and everybody keeps looking for hyperinflation or elevate it. We certainly are seeing inflation now, if you measure it correctly. But hyperinflation is a currency event. That's what it is. And and why prices go up so quickly is we lose confidence in the currencies. And these currency crises of the 52 that I've looked at, they don't last very long. They're measured in weeks and months, maybe a couple quarters. Look at Zimbabwe, how fast it happens. So when you lose confidence and the velocity of money then takes off, because as you know, velocity of money has been plummeting, which suggests the kind of fear and the lack of real investment. So when that shifts, so what will shift it? Well, what typically starts to shift it is you're not getting enough growth to sustain the kind of debt that we have. And what's happening right now globally is we have a slowing aggregate demand overall. We have gutted the middle class with real disposable income shrinking. It's not just in the United States. It's in all of the developed countries, especially as the entitlement programs are really unfunded, now coming to fore, and the earnings not staying abreast. And when you have debt at the level that we have, and I'll give just some quick numbers for you, our debt globally is approximately 150 trillion of debt instruments, about 50 trillion of equity instruments. At 150 trillion, let's just say that the interest rates that you would be paying on that debt service are between 3 and 5%. So if not much higher, but conservatively, 4%, 150, we're talking $6 trillion. So that's a year. that is sucked out of the economy, $6 trillion. Now, what's the global GDP? Approximately $70 trillion. Well, what's the global GDP growing at right now? Well, the IMF claims it's 3%. I would argue it's much lower, but let's use their 3%. And so hope that it sustains. Well, 3% of 70 trillion gives you 2.1 trillion. Well, I think we just got a $2 trillion shortfall that's literally disappearing and being sucked out every single year. That it's not being made up by at a rate fast enough for new wealth creation. And that doesn't take into fact non-performing loans, which are accelerating. Look at student loans, etc. It doesn't take into effect of the amount of malinvestment that we have now had, and you see that in covenant lights, PIK loans, etc., because we've had this sustained, I'll refer to it as monetary malpractice, where we've had moral hazard, unintended consequences, which has distorted the markets. It has left us with our inability to get price discovery, and therefore we have mispricing of risk. I have never seen risk so blatantly mispriced as it is currently. And when you get this kinds of distortions and delusions, typically you get a rapid dislocation. And that's that's the exposure we have right now. And that's called a market shock. Earlier before the call, I was just looking at what's going on in Dubai. Out of nowhere. Yesterday we weren't talking about Dubai. Today we're talking about Dubai. I'm not saying that's it. But things will come out of nowhere.
Well, what happened in Dubai?
Just concerns with their whole sovereign wealth fund and the money and the investments and and building contractors, the large contractors of the buildings that they put up, and whether in fact they were good investments. They're not generating the cash against the debt, even at cheap debt. So then you've got to refinance it. And so far we've been able to keep refinancing and rolling a lot of the malinvestment. But at some point what happens is the collateral, and I mentioned this earlier, the issue is that the collateral out there that you need to post to get debt has been pledged so many times. Ready for this? Multiple times. There's something called rehypothecation, where you're cascading, because it's unpoliced, you're cascading collateral and being posted multiple times as leverage to borrow more money. And then,
so for example, let's say you have a bar of gold, and you're saying, I'm putting this up as collateral. But yet they put it up as collateral to Bob and to Frank and to Mary and to, Muhammad they put all this same bar up for collateral. And then when things blow up, then all these Mary, Muhammad, and Bob and Mary, they all come and say, where's my bar?
You got it. And then you just described what's going on in China as today in the metals marketplace. So in the metals, and all of the metals, because the imports are such a huge part of the country's economy, exports being larger, but they import, and metals and these kinds of products are such a huge amount. They've been using warrants and other kinds of techniques to leverage up their lending because their profit margins have been so thin. So you've got that in cascades that they're trying to get under control right now as we talk in China. But it's broad-based. It's all instruments that across the board. So if we were to have a stock market correction that lowers equities, if we were to have bonds that suddenly went down in price,
up in yield,
and up in yield, exactly, the cascading effect is staggering, and therefore the central banks know this. That is what they're fighting every single day, and so I personally believe we're going to have a stock market correction consolidation in a not too distant future, but it isn't going to be the kind of correction that you saw. It'll be, we're going to feel a little pain with it, but the central bankers can't afford to allow, my assessment is more than 14%, because of the cascading effect, not only in equities, but right across and even into the bond markets.
And I know you say they can't afford it, but doesn't something have to give? You can't have nirvana. Everybody can't have their cake and eat it too. Wouldn't the dollar take a beating? Would there be a currency crisis if they stepped in? Isn't that the ultimate end to this? A massive, quick, brutal devaluation of currencies, namely the U.S. dollar, the biggest one in the world?
Well, you're right, but I happen to believe that the last to fall will be the U.S. dollar, though I happen to also believe it's the worst, being maybe the least ugly at the party in some ways, and that's only because when fear creeps in, there's a flight to safety. And I would not say that the U.S. equity markets or bond market, specifically the bond market, is the safest, but it is relatively safer. So, there's a lot of people that get caught on the wrong side of that boat. But you're perfectly correct. At some point, there has to be a clearing mechanism. And it's a healthy thing. It's something that's needed because new investment, and that's our problem. Investment won't come in when it's overpaying or the risk is too high or there's insufficient return. The way you typically do that, you bring down prices, it brings in new investment, it's invested correctly, it's generating real returns so that capitalism works, where in fact the investment creates savings which goes back into capital investment. We're no longer doing that. We're not really running a capitalist system, we're running a credit system. And we're using, instead of savings, we're using credit. And credit, and I'll be a little harsh with the words, credit, the way we're doing it now, is really a form of counterfeiting. And if you look at the $72 trillion shadow banking system that we have operating right now that's generating this credit, borrowing short, lending long, it collapsed in 2008 because of the asset-backed commercial paper market. And now we're using these repos and we're using collateralized transformations to try and patch them up like we used AAA, the credit default swaps in 2008. It's on a hairy edge, but it's not mortgages this time in housing. It's student loans through Sallie Mae that the students don't have any hope of ever paying this back if they find jobs. And look we're talking, north of $1.2 to $1.3 trillion. It's car loans this time because
subprime.
the subprime, and that's the way to look at car loans. They're subprime now.
Yes. And this mirror, drive a new car.
And the gig there is when housing broke, it was when we found out that the housing price wasn't worth what we thought it was worth, and they had to take them down. Well, the people are buying new cars today. Well, who's buying used cars? And you can't afford a used car in that the maintenance bills are so high. Everybody's kind of got a used car, or new car rather. But what about we're selling 15.4 million new cars. What about these used cars? And the moment you can't sell them and look at the auctions, as far as the eye can see, then you've got to start taking down the residuals. That changes the leasing prices. You've got it in real estate investment trusts associated with retail commercial real estate because of this massive shift that's going on to automation, to less floor space, to going to online in retail. And you got these highly leveraged real estate investment trusts also operating through the shadow banking system. I don't mean to get technical here, but these problems are blatantly evident. But I don't think right now that the powers to be have any control over them.
Two final questions. Is it worse now? Is what's coming worse than what came in 2000? I was on an interview with in the radio the other day, and I said, I think 2014 is going to be like 2007, only worse. I think 2015 is going to be like 2008, only worse. That's my thing. I just think these 2 years, 14, 15, going to be far worse than 7 and 8. What's your assessment?
I think that 2008 was an early warning signal of the magnitude of the problem. We didn't fix it. We did extend and pretend. Dodd-Frank did not solve the underlying issues. The global swaps market has went from 600 trillion to 700 trillion last year alone. We've watched the shadow banking system push through $72 trillion. So they didn't stop it. We've just in fact inflamed it even worse, and we've got into even riskier kinds of assets. Now, where that leads, I'll let our listeners speculate. Is it imminent? No, I think we're talking probably into 2015. I think we've got still a little bit of a deflation scare in front of us before we start to get into the hyperinflation, which is the currency fear. Again, don't underestimate the central banks and the politicians' ability to kick the can down the road. They've still got some more bullets here.
Okay, and then the final question, what happens if we have full-blown civil war in the Middle East? I mean, really this ISIL or ISIS, these quote-unquote terrorists that the U.S. funded. We funded the Maliki government, and we funded both sides. Now the president says, well, we don't want to play whack-a-mole. Well, of course. Who are you going to shoot at? But they're going to shoot. I mean, the borders between western Jordan and Syria and Iraq are poof. What happens if there's threats with this terror group saying that they're going to use a nuke against Israel to free the Palestinians? I mean, what happens if this, whatever it is you want to call it in the Middle East, the fight against the Sunnis and Shia, or civil war, or terrorists, or what happens if this gets way out of control?
And I happen to think that it probably will, because we're not resolving the inherent basic problems, and we really haven't addressed them. But where it leads to is the big core issue here is the petrodollar. And it's not about oil, or it's not about gas, more now the gas than oil. It's about what it's bought and paid for in, and that is U.S. dollars. And there's nobody that trades any one of those products in anything other than U.S. dollars. That's a fact. And if they do it right now, as of today, and that's why the Russian-China deal was so important, that 30-year deal that was signed here in the third week of May between Putin and China, what it was going to be denominated in. And temporarily, at least on the surface and why it was delayed, it was in U.S. dollars. So as long as the trading continues in U.S. dollars, the amount of U.S. dollars that are out there will stay out there, relatively speaking, though it is shrinking, will not come back to the United States. When it comes back, you will have hyperinflation. So what would trigger that? Well, Iran right now is threatening that their bourse, they're going to sell it in anything else that they'll exchange it. The agreements that are being struck between the BRIC alliances of Brazil, Iran, India, China, and Russia, they're right on the border. That's why they're buying gold. They're on the border of starting to trade. They've got 13 different agreements where they're going to trade in their own currencies, not using the U.S. dollar. And so these conflicts need to be seen in the context that they're really going to force them into trading with groups in other than the U.S. dollar. And that's the problem, because that's going to come back. They're going to say, I got a U.S. dollar, I'm going to make a claim on it. We got to ante the value for it. That's what's going to drive hyperinflation. That's what's going to drive a currency crisis. And it's systemic. I mean, it's right across the world. And the commonality of these crises is often food prices. People will put up with corruption, they'll put up with a lot of problems, but if they can't feed their family, or if they don't feel safe, suddenly corruption and these things bother them, and unrest comes through. And so food prices have been shooting up. The United States hasn't been subsidizing the way we have before. I'm not suggesting we should, but our changes in a lot of this export subsidies we've been doing have been causing these kinds of problems. So that's what it's going to lead to. That's what this is about. It's about trading in the U.S. dollar.
And you think that breaks down sometime in 2015?
We do a tremendous amount of technical analysis, and so it's just not looking at the macro and all the logic that goes into the macro. When we look at the charts, right from the currency charts, equity, all the various forms of credit charts, and our monthly, weekly kinds of a level of analysis, we take it right down to 60 minutes. There's some pretty clear patterns. It suggests that, I don't know whether we're right or wrong in that, but it says that a lot of people think in the way I'm describing here in this call that are currently in the charts. Now, charts change, of course. 2015. 2015, sometime in the spring, Q3, there's trouble there. Could roll further, but as of what we understand right now, that's what it looks like. Gordon T. Long, GordonTLong.com. Thank you so much for coming on and enlightening us and educating us about what's going on in the world economic picture, the U.S., the Middle East, the dollar, bonds, the whole thing. Thank you very much, Gordon Long, for coming on USA Watchdog. Oh, thank you very much for having me. Enjoyed it.